Banking Book Webinar Series 2, Episode 2, Maximizing Deposit Margin and Growth in Low-Rate Environment, presented by BBA.
Welcome everyone to our webinar on BBA webinar on maximizing deposit margin and growth in low-rate environment. And today we have Suhail Farouk, our CEO, previous from Moody's, Oliver Wyman, HSBC, and our advisor in Papawa, previously at OSFI and DICO, an advisor. And the session is going to be approximately an hour. And this session is being recorded. There is a polling that's going to come up if you want to vote in that. And in the end, you can either you can put your questions in the chat or just email them to me, and we'll have a question answer about the last 15 minutes or so of the webinar. Thank you very much, and the floor is yours. Suhail and Andy.
Thank you so much, Paula. So welcome everyone. Really excited to be here today. And quite frankly, the topic that we are going to cover is also of great interest, and especially within the context of COVID-19, because a lot of the assumptions got changed as a result of COVID-19. So we're looking at pre-COVID-19 assumptions and then post-COVID-19 assumptions, and trying to draw the conclusions based on analytics and the frameworks that we are going to present. But before we begin, I think it's important for those of us to know a little bit about who we are and what is it that we do. BankingBook Analytics was formed in 2018, to be very precise, in the month of June. And we essentially develop decision support systems for financial service organizations. And our offering is organized in two broader areas. The first and foremost is software as a service solutions, and the second is advisory. In software as a service, we have pre-built applications that cover three important domains: finance, operations and treasury, and risk. And within that, we have some interesting applications that I'll be sharing with you shortly. I'll be showcasing those shortly. And then in the advisory area, we sort of extrapolate what we provide in terms of the analytics in our software as a service solutions, and assist our clients in understanding and developing solutions to the problems that they face, both at a tactical level and at a strategic level. Okay, so as I said earlier, that we provide, our applications provide coverage for three different domains. And within that, we've organized them in terms of planning and forecasting, behavior and profitability, risk quantification, and compliance. For those of you who are interested to learn more about our applications, we'll be very happy to organize a demo. But that being said, some of the applications that we think that we've brought forward are really cutting edge, and they fill a huge niche that exists in the marketplace with regards to the analytics, with the specific focus on small to mid-sized financial institutions who are always worried about the ability to extract data and to be able to analyze that data. Our applications provide an accelerator level approach in terms of data extraction and developing the analytics around it, focusing on capital management, transfer pricing, compliance, regulatory compliance, and risk-adjusted profitability, and so forth. So we'll be very happy to actually run some demos for you if you'd be interested in. Please feel free to reach out to Paula, myself, or Andy. Okay, so in terms of our advisory, as I said earlier, the focus is really tertiary to our software, and that focus is mainly around regulatory compliance, non-financial risk management, again, finance, treasury, and risk management, as well as pricing and profitability service. So for those of you who are interested to learn more about our capabilities, please drop us a line and we'll be happy to chat more. Okay. One of the things that we bring to the table within the context of advisory is really the benchmarking of the best practices. And within that context, today's webinar is very topical. I'm not going to get into the detail of what else we offer, but let's just jump right to the webinar itself. Before I begin, I'd like to pass over to my colleague, Andy, for a brief introduction, and then we'll start going over the agenda and what we have in store for the rest of this session. Andy, over to you, please.
Well, thank you, Sohail, and it's a pleasure to be with everyone this evening as well, or this afternoon in some cases, and some other places evening and morning, I guess. Delighted to be with everyone today. We are, as Sohail has mentioned, a young firm, but we have lots of experience, as you can see from our ages, at least my age anyway. A number of years of experience with OSFI in Canada, the federal regulator of banks, pension funds, insurance companies, and after that, 25 years in the non-bank financial services regulatory sector. Still doing a lot of consulting work both in Canada and internationally, and I'm pleased to advise BankingBook Analytics on various components of their offering. So be happy to be with you this evening, and looking forward to the conversation. Thank you.
Great. Thank you so much, Andy. So let's just begin with the agenda that we have. So before we begin, I'd like to set the context. Earlier this year, we were all talking about the probability of rate hikes and the impact on the balance sheet. And a lot of the calculations, a lot of the budgets were drawn up based on that assumption. But then all of a sudden, in February to March time span, we got hit by COVID-19 and the rates were dropped down significantly. So those assumptions got changed, and a lot of initial targets were either ramped down or were reassigned based on the new assumptions. So the banks are faced now with this challenge that, they have low interest rates, which are historically low, as well as the spreads, i.e. the lending versus the deposit spread is also dropping down. So the budgets and the anticipated drop down in the rates is now compelling financial institutions really to either look at the alternative approaches to generate revenue or to really cut down the cost associated with the interest rate payments, i.e. to the depositors. And that phenomenon itself is known as the betas. So by transferring the low rates to the depositors, the banks are now possibly trying to improve their margins. But if you look at the liquidity situation that we have, that also remains uncertain. So on this side of the equation, we have to worry about the liquidity, while on the other side of the equation, we have to worry about the profitability. So this is really a bit of an optimization problem that we are faced with. So in order for us to understand how best to deal with, we need to be able to develop some sort of analytics, and around that analytics, a framework-based approach which will allow us to really understand the behavior of the depositors and identify which segment or which portion of the depositors is rate sensitive, which portion of the depositors is volatile, i.e. is of course, with the propensity to leave the organization and search for better rates. And of course, the key question that needs to be answered is how much or what is the magnitude of the deposits which are considered to be the core deposits with the ability to stick with the organization on a longer term basis. So that's really the agenda for today's conversation. And as Paula said, if you have any questions, please feel free to stop us, ask those questions, and we've got some very interesting polls for you as well. And once this webinar is over, this will be uploaded on YouTube for you and your colleagues to be able to actually share electronically. And for those who signed up, they would also receive the copies of the presentation, which probably have already been. Nonetheless, moving on, our starting point is really understanding the current state analysis. So as I said earlier, on one side of the equation, we have to worry about the liquidity. On the other side of the equation, we have to worry about the profitability. And what that implies is that we need to be able to understand that there's also a competition outside with regards to the rate, and there's the pressure on banks and credit unions to compete. So that also means that there's a challenge from the point of view of retaining the deposits. So that leads us to the question that what kind of cash flow prediction we can develop, and what kind of rate-based competition exists. And then, of course, if we were to actually upstream this cost of funding concept, how is it that this cost of funding actually translates into a profitability metric for the organization, which is internal to the organization as opposed to the external to the organization. So all of this is really part of this one big spectrum around deposit modeling and deposit characterization. So when we look at the models which are out there in terms of balance sheet structuring, we come across two different models. The first is, of course, the deposit-led model. Now, key characteristics of this deposit-led model are actually on the right. They essentially rely on deposits for the funding of their operations. Of course, with regard to some securitization, there is some reliance in terms of generating additional wholesale level funding, and then generating the contingency-based high quality liquidity assets. If they don't really have any treasuries or any sort of cash, near cash terms on their balance sheet. This model is inherently less diversified, so its focus is really on sort of ability to create the spreads and improve upon their margins. So that's a model that we are going to be focusing more. But on the other hand, we are also looking at another model, which is really assets-led model. In this model, we have a high level reliance on securitization, and of course, focus is not just on creating credit assets, acquiring the credit assets, but also on developing an investment portfolio. By virtue of this investment portfolio or investment banking activity, there is more diversification in terms of the revenue generation and less reliance on deposits, relatively speaking. Now, of course, both models have their strengths and weaknesses, but all things being equal, the assets-led model is relatively high risk because of the sort of reliance on capital markets, reliance on counterparties in terms of generating the wholesale funding capabilities and so forth. So any sort of defaults that can potentially take place can lead to a situation that we saw in 2008 and 2009. So really, yeah.
So at this point, just sorry to interrupt you, but a question I had in my mind as you were speaking there. At this point in the economic cycle, given what's going on around us, around the world, what are you seeing as the sort of primary business model that most institutions are employing at this point in time in the cycle?
That's a very interesting question. So I think we have captive users of asset-led model, and those are really the big six Canadian banks. I think if you were to actually exclude those big six Canadian banks, most of the financial institutions are really deposit-taking institutions are really focused more and more on the deposit-led model. And as you will see, Andy, in some subsequent slides, that we've seen the share of deposits in terms of generating and providing liquidity continues to increase in Canada, and in not just in big six banks, but also in the non-big six banks category, which we call small to mid-sized financial institutions. Does it answer your question, Andy?
Yeah, I would agree with that. One of the banks, I sit on the board of a bank and a small bank, and one of that bank in particular, I guess as a general comment would be that clearly it's becoming a deposit-led business model.
Yes.
As there's all kinds of issues around getting into various elements on the lending side. And again, looking forward, there's a great deal of uncertainty with respect to what the future looks like from a credit risk perspective. So I think it's fair to say that deposits are not a huge issue for small institutions today, especially given the level of deposit insurance and other safeguards that are put in place in capital and so on. But I do think that the asset-led model is a higher risk model. I think most smaller institutions are veering away from there.
Exactly, and especially in post-2008 crisis. And Andy, as you were just speaking, I had a sort of brief glance at one of the studies issued by CIBC today, which says that Canadians are sitting on historically largest hoard of cash. So that essentially implies that there is, of course, a lot of liquidity that is sitting out there, but at the same time there are also a lot of users of liquidity who are actually interested in sort of nibbling away on that liquidity and acquiring the assets. So as you said rightly, there is a lot of liquidity. That being said, understanding the dynamic of that liquidity becomes extremely important, and that's really the core topic of today's webinar.
Precisely, and I think as we'll get on to the conversation in a moment here, I think we'll see some mechanisms that can help, sort of manage the process of migrating away from where we are today to a more sort of sustainable corporate model, I guess, for deposit takers in particular. Thanks.
Exactly. So now let's just set the stage for today's webinar, right? We set out the context, we provided the background, but let's just look at how the rate market is moving in Canada. So what we did was we actually ran an analysis in Bank of Canada's data and identified that the overnight repo rate, which is really a function of demand and supply of liquidity requirement, and is really not driven by any sort of prescribed rate, has been dropping down significantly. Now, as you can see, that the trend line showing that this is continuously going to drop. So we are right now at about 58 basis points, and this was high at 4.34%, in pre-2008 period. And, and likelihood that it is going to stay here for a considerable period of time is really, really very high. And that has implications on how the business is organized and how the business models are developed, right? Similarly, I think another interesting sort of site is looking at the interest rate spreads. Now, interest rate spread, if we were to define it, is really the lending rate minus the deposit rate. Now, over here also, what we're seeing is that, this interest rate spread has been trending downwards and is likely going to be even further trend downwards. So we are looking at about 2.2%. There are two or three implications again, and as we always talk about, the dynamic that exists, both on the users of liquidity as well as the providers of liquidity is extremely important, and that relationship needs to be developed. So from the users of liquidity perspective, we've got these credit assets that are being generated on the balance sheet. And from the providers of liquidity, we've got these depositors. Now, they're both important pieces of the equation. For the users, what we need to know and what we need to perhaps look at is that what kind of framework can be developed in an integrated fashion, which can really transfer the liquidity dynamic to the users in a way that is comprehensive, in a way that is integrated, in a way that is going to provide us with a metric which is going to help us internally define the profitability on a risk-adjusted basis. So that's an important piece. From the other side of the equation, from where we're looking at the providers or the sources of liquidity, again, we need to be able to understand that what kind of betas we can apply, where either we can provide or a lower rate and with an assurance that the depositor is not going to leave us, or for those who we think are either volatile, we are going to either transfer them into a fixed rate, fixed term setting, or perhaps, migrate them into a more core side of it by identifying on an upfront basis or a pre-factor basis. So that's also an important aspect. Now, all things being equal, we are not talking about changing the business model here. We're talking about running with a deposit-led model and trying to develop key analytics, which are important. Right. Andy, any comment here?
No, I think you've covered it off. I was going to ask a question, and then maybe this is not the right place, but I'll ask it anyway. In some countries in Europe, Switzerland, Spain, other places, we're seeing negative interest rates. I was wondering if you might comment on that in the context of this kind of a spread analysis.
Well, that's a very interesting observation. Of course, I think negative interest rates um, is really some of the banks in Sweden, Scandinavia are actually paying the borrowers to actually borrow the money, in terms of putting it, acquiring, undertaking the mortgage type of activity and so forth. There are longer term implications of negative interest rates, but in the short term, of course, that money is put to use. It sustains the economy, and of course, it has an important benefit from the perspective of continuing to develop a substantive economic activity. But this is not sustainable, of course, from the perspective of the providers of liquidity. And the providers of liquidity are always searching for avenues and opportunities with regards to getting the higher return. And there's an opportunity cost associated with that. So I'm not sure how sustainable that model is, Andy, and not sure at the same time, whether or not this can be undertaken on a sort of on a going concern basis. So that's the sort of my thought on that.
I hope it never happens in Canada, because I think it's going to create a lot of more uncertainty, as a matter of fact. So,
absolutely. Absolutely. Yeah. Okay, great. So we talked a little bit about the importance of deposit, and we also talked about how deposits are connected with the asset acquisition activities of the balance sheet. But in Basel 2.5 and Basel III regulatory regimes, we see that deposits have also become now a cornerstone, a major and important building block of compliance. By the introduction of some really important key ratios from the liquidity perspective, and these are liquidity coverage ratio, net stable funding ratio, and for those of us who are involved in advising financial institutions, and those of us who are also responsible for compliance related activities, it is now becoming increasingly important to develop analytics with regards to the runoff rates of deposits, with regards to understanding and developing contingency plans should there be a drop in funding side of liquidity and so forth. So again, a very important piece of the puzzle that needs analytics, that needs an understanding, and not just a rule of thumb based approach to be able to actually come up with compliance relating to these important aspects. And let's just not stop there. When you look at the stress testing from a liquidity perspective, deposits play a very important role. And as we said earlier, the runoff ratios, the runoff rate factors within the 30 days or greater than 30 days become extremely important. So hence the need to develop another reason to develop analytics with regards to the deposits, high quality liquidity assets, as well as the availability of or retention of liquidity buffer from a stress perspective. Great. So that brings us to really a very interesting slide. In this slide, we are looking at various instruments which are used by the big six banks in Canada with regards to developing the funding of their operations. So as we said earlier, that effective funding model is important. Now, and there has been historically a lot of diversification that has come into play. But that being said, deposits continue to be the bedrock of liquidity here. So if you look at this slide very, very closely, you will notice that the securitization or structured notes activity has taken over the deposits from the perspective of the provider of the liquidity. And then deposits are about 29%, and 32% is the securitization activity. And then about 15% are again covered bonds, i.e., again, sort of a balance sheet backed issuance of the bonds, which allows for further funding. Now, one of the big reasons for 2008 crisis was really sort of the kind of liquidity that gets generated by securitization can end up in acquiring the wrong assets, and that can lead to a domino effect with regards to the collapse of major counterparties. We remember the example of Bear Stearns and so forth. So again, a lot of historical context here, but that being said, these areas are available. We always advise our clients to actually identify the contingency plans based on, counterparty-based funding or wholesale funding, and not just that, keep the hygiene of the assets so that there is a resilient balance sheet. And should there be an opportunity to actually tap into the capital markets with regards to the commercial paper or any securitization-related activity, you have clear and unencumbered assets in the warehouse, which you can launch from a securitization perspective. So again, a very diverse toolkit that exists from the perspective of funding within the financial institution system in Canada. Good. So as we build upon our sort of current state analysis, one of the important trends that we are now actually beginning to see is the divergence that is emerged between the demand deposits and the term deposits. So as you can see that the gap is continuously getting wider and wider between the demand deposits and term deposits. So term deposits are getting relatively stabilized at about, and this is for the entire Canadian financial system. So we're looking at about $1.2 trillion of demand deposits as opposed to a $600 billion, of the term deposits. So after sort of increasing the gap, this is sort of, plateauing, and demand deposits continue to rise. And this study actually dates back from 2000 all the way to 2019 Q3. And I would imagine that 2020 would not be different. Now, one message that comes out of this slide is again underscoring the importance of demand deposits here. And when we say underscoring the importance of demand deposits, as we will see in some of the subsequent slides, that we need to be able to slice and dice our demand deposits to understand what is the longevity of demand deposits on our balance sheet. How are these demand deposits volatile from the perspective of their volatility, and what portion of demand deposits is really rate sensitive, i.e. they're always looking for the higher return or higher incentives, and from the perspective of shopping around and understanding, which financial institution can provide them with the better return and so forth. So technically speaking, they're loyal only to the highest paying or highest return provider and not just to a typical financial institution. So that's also an important takeaway here that, either we convert our demand deposits into the term deposit or we actually sort of start analyzing their role in terms of providing sustained funding to the balance sheet.
So Sahil, on that slide as well, and the next one as well, I'm sure. So the current environment where interest rates are low, probably at historic lows again, as we saw in 2007, 8, 9 to some extent. What's your take on, is this behavior that you're seeing on this slide in particular, is this abnormal, or is this what be expected in this kind of situation?
That's a very interesting question. So, as you know, Andy, that uncertainty exists, and I think the severity of uncertainty is perhaps across different segments, and consumers, who are the personal deposit providers, or the commercial industrials, who are also the deposit providers from a commercial perspective, they're all sort of faced with this type of uncertainty. And of course, if we were to actually extrapolate it from the savings perspective, we've got the financial institutions here. So I think this is going to sustain itself over the foreseeable future, and perhaps, the focus might even shift, or the weight might even shift more towards the demand deposits as opposed to the term deposits.
Great, thank you.
You're welcome. Great. So I think the good news here is that, we've got plenty of cash. There's hoard of cash that Canadians are sitting on it. But at the same time, the bad news is that there is some uncertainty, and we are not sure how it's going to play itself out. Now, in this slide, what we are showing is that, with a certainty which goes to 2 standard deviations or about 95%, the deposits can stay within the range of, say, about 3,000 or 3 billion to 7 billion. You can come up with any number here. But the idea that we want to convey here with this slide is really that this is backward looking, this is historic, there might be an assurance of 95%, but that being said, this assurance is limited to within the context of the data that we have on a historical basis. But how can we actually look at the future implications, as we talked about the uncertainty that exists, and as we've seen the term deposits converting themselves into demand deposits, and shown earlier in the slide. So that's really sort of a key question to come to grips with, and we'll try to get answers to that.
To Hal, we have a question here from Antoinette. She asked, given the trends, demands versus terms, what strategies are suggested?
Pardon, say that again, please.
Given these trends, demand versus term, what strategies are suggested?
Exactly. So yeah, that's a very important point. Thank you so much for this question. So I think we plan to address this question, but I'll just sort of do a brief sidebar with regards to the first and foremost strategy is really analyzing, and as we said earlier, analyzing the typical length of the deposits. And in order for us to do that, we look at deposits in 3 different cohorts. We look at them, what we call the core deposits. And we assign a certain duration. Some organizations say the core deposits, the term associated with them is about 2 years. So any deposit that can stay within the organization for a period of 2 years, it could be construed as a core deposit. Then the second segment or second cohort is really those what we call the rate sensitive deposit. Now, rate sensitive deposits are always shopping around for the higher rate, and their sensitivity is very high. So for us to be able to address the need with regards to the higher return to that rate sensitive deposit is either try and convert those rate sensitive deposits into a term deposit with relatively higher rate, offering them GICs, offering them other sort of incentives so that their needs are addressed, or offering them within the demand segment a product that can be launched which would actually address their need based on a certain indexation. So you can index them with the money markets, or you can index them with any other sort of tool which will allow them or give them the kind of assurance that they're not being treated unfairly within the organization. So that's another segment which needs to be looked at. And then, of course, the third segment is what we call the volatile segment, which has a lifespan of less than 2 years and is either sort of shopping around or is really sort of worried about their day-to-day uncertainty and their cash flow needs. Now, that segment also can be sort of their needs can be satisfied by either offering them a higher rate or by offering them any sort of cross benefit within the organization, perhaps tie them up with a line of credit or so forth, so that they stay within the organization. So that's the sort of the third segment. Now that's one side of it. The second side of it really is, as we talked a little bit earlier around transfer pricing. So knowing that what importance deposits have, I think it becomes extremely beneficial to the organization to understand what is the cost of funds associated with it and how they can create the spread. So as I said earlier, that when you talk about the spread, we are talking about the risk-based differentiation. And now risk-based differentiation, which is really around the credit worthiness of the assets that we have. So from the pricing perspective, the lower risk asset should have a lower price, and the higher risk asset should have a higher price. So that discipline, which transcends itself from deposits all the way to the asset side, needs to be actually implemented. And we will talk a little bit more about that. That requires full understanding of every product on the liability side, and then its application from the perspective of the the pricing, which is around the asset acquisition and risk-based pricing, and not just that. Then the next important part that becomes extremely important is also insulation from an interest rate risk perspective, so that your liquidity stays where you want it to be. You want to have a certain buffer so that your liquidity does not get impacted by sudden movements in the interest rate curve. And we're not talking about the interest rate curve which is external to the organization. We're talking about the interest rate curve which is internal to the organization. So essentially, you're operating on a certain yield curve, which is really an internal yield curve to the organization. So that sort of is almost the summary of our webinar, but I wouldn't stop here. I would continue on some of the next slides. But like I said, please feel free to reach out and ask any questions that you might have. So that being said, what we need to do here is we need to be able to identify some of the questions. So what question is that what portion of our balance sheet can be considered, what portion of our deposit balances can be considered as stable and long-term? We talked about that, and we call that a core bedrock of deposits. And then we also want to know that how the balances decay and how can they be invested. And we talked about the funds transfer pricing here, and we also talked about the variable or interest sensitive deposits, which are important, and that can lead to a certain decay. And then the final question is that how do we match deposit pricing and stabilize earnings? Again, we talked about the creation of internal yield curve and identification of each product and developing the product book and mapping the profitability from each product's perspective, not just on the asset side, which has always been the focus, by the way, but also on the liability side. So we want to be able to create profitability on the liability side so that there is an adequate incentive from the liability manager's perspective or the treasurer's perspective to be able to retain and hold on to those very, very important sources of liquidity. Okay. So what are the analytics to consider? So yes, we have only about 15 minutes to go over the remaining slides. So here we want to actually nail it down. So the first thing is balances. How do we create understanding of the balances? The second important part is the transfer pricing. So we want to know what is the mechanism for calculating the net income at a level lower than the level which is available to the external readers of financial statements. So what is in fact the internal net income process? The second important aspect is that can it be done by business line and product? And the third is that why is it critical that we want to be able to measure the risk-based performance of our assets? And all of that sort of gets linked with the liability modeling or liability side of the balances that we're going to talk about. Now here, for our attendees, a very interesting slide. Now this is really a movement which shows us that, if we can come up based on a certain historical data, that what is really the range of deposits that we would consider as core. And then we kind of build on that analytics that we go from the core to the volatile deposits, and then we again slice them further, that we identify what are the core deposits and what are the rate sensitive deposits, as we talked about, and what are then the volatile deposits and what has been their sort of behavior over certain periods of time. We can either create some kind of mapping based on our current or present day situation with the past, so that we are able to identify what behavior has been exhibited by the depositors. And then we can also identify our liquidity needs and start creating the products which can start pulling away the other rate sensitive depositors at other financial institutions, so that you can continue to enhance your liquidity situation. So that's also another benefit that can emerge as a result of developing these metrics. So most large banks regularly update their statistical approaches to understand their core deposits for ALM and liquidity purposes. I'm not going to get into the details of what kind of analytics is done, Of course, BankingBook Analytics is happy to assist you with that type of work. We are happy to work with you, not just from a going concern perspective with regards to deposit modeling, but also from liquidity coverage ratio or net stable funding ratio to be able to provide you with the stress level runoff factors associated with these ratios and provide you with that sort of analytics and analysis. Great. So I think time is now for a poll. What I'm going to do is I'm going to actually send the questions your way, and let's just try and answer those questions so that we can identify what has been your experience or your gut feel with regards to your institution's deposit split, i.e., what percentage of deposits can be construed as greater than 2 years within your organization, and what percentage deposit can be construed as less than 2 years. And this can be done for both retail demand and retail savings. So let's just run that poll. I'm going to do that right now.
So just so everyone knows, on your screen on the far right-hand side is a little icon that looks like a bit of a, I guess it's a pyramid with a dot on it. If you click on that, you'll see the poll.
Yeah. Okay, so this poll is live. Great, we have some responses. And then we're going to do the same with the second poll. So what is the split of retail savings deposits at your institution in terms of short-term and long-term? So we talked about the demand deposits, which are essentially can be withdrawn at any time, or also called notice deposits. And then now we have the second poll. While you're at it, let's just continue to sort of go over the presentation. So now we are at the second important aspect of this analysis, which is the transfer pricing. As we said earlier, what transfer pricing essentially means is that you are developing an internal yield curve. So, you're developing bid and ask spread for rates on your internal yield curve. Bid is really the sort of the demand for the deposits, and ask is really the supply of the deposits. So it allows really from the development perspective that what sort of is the internal cost of funds. Now, the important aspect here is that you can also start generating or assigning liquidity premium to your transfer pricing curve. And by doing that, what you're trying to really do is creating that buffer or pricing for that buffer, which you can use from the perspective of liquidity coverage ratio or net stable funding ratio. Okay. Great. So here we're talking about the demand, the strategies for retaining the deposits. Pardon me. We have three important questions here. Let's just move from a tactical to a strategic aspect. So from the tactical aspect, we need to be able to get the basic characterization of deposits correct. What are our long-term deposits and what are our short-term deposits? And then, what kind of approaches we can use. Here, if you want to actually create a model-based approach, you can use different approaches. You can use a regression analysis. You can use a replicating portfolio-based approach, which is going to allow you to look at deposits from the perspective of what is the mapped portfolio if you were to think of these deposits as a medium-term bonds or medium-term paper or short-term paper, and then start assigning sort of the liquidity premium or the cost that you would be paying by issuing these bonds and so forth. This also is a good notional exercise, which allows you to understand that what would be the rate that you would be paying the capital markets. Are you paying lower rate? And of course, deposits are relatively cheaper, so you end up paying the lower rate, but it allows you to actually notionally run that through within the treasury organization. And then how you can actually generate new money to be able to fund the acquisition of newer assets, right? So I'm not going to get into the details of this slide as we have limited time, but happy to go over this, on a one-on-one setting. Second piece is really, on transfer pricing, and we talked about the transfer pricing. It is also, again, from tactical all the way to strategic, and then, a typical gut feel is that, we can price our deposits higher, and this is going to allow us to really generate more funds to acquire more assets. But as we talked about, the depressing spreads associated from lending perspective. So is that strategy counterproductive, or is that strategy very, very effective? So that question needs to be asked. And then again, what kind of flow we generated. We talked about the interest rate sensitive deposits. And this typical fractional segment of deposits exists invariably at all financial institutions. And, by creating the analytics, you can sort of create an increased flow. And then final piece is from a strategic perspective, how we can optimize the balance sheet to maximize the value for our stakeholders, for our shareholders, for our capital providers, and so forth. So, within that context, that optimization exercise is fairly large. We are happy to assist yourselves with that, but again, we're not going to be able to, due to the time constraint, we're not going to be able to sort of get into the details associated with balance sheet optimization. Final piece. So finally, moving from a more macro to micro perspective, it allows us to develop balanced tier. It allows us to understand the demographic that we're dealing with, and identification of the separate markets within the deposit segment, and allows us to develop tailored strategies so that we can create the products that addresses the needs of these sort of segments. And finally, use the sensitivities from an interest rate perspective to your advantage, as opposed to allow yourself to be used by other sort of financial institutions. So thank you so much. Any questions? We're happy to answer.
Okay, great, Sohail. Thank you very, very much. I had 3 questions on DM. First of all is, what kind of data is required for developing deposit analytics?
That's a very interesting question. So from a data perspective, I think what we are looking at a historical data that can potentially go as far back as possible on a month-to-month basis. That's one. And the second is what has been the interest expense associated with different types of segments. Now, a great starting point is really to look at what we call the liquidity coverage ratio. It's a very interesting ratio because it inherently gives you different deposit-based segments as is. So it talks about demand deposits. It talks about the both from personal and commercial perspective. It talks about the deposits which are used for the operations. It talks about deposits which are in escrow and used from a clearing perspective and so forth. And also deposits which are kind of considered as quote unquote self-deposits. So we can use that as the basis and really create those segments and identify what payments have been made from an interest expense perspective. So that's a great starting point. As I said earlier, going as far back as possible, but technically it should be before 2007, so that we can create a normalized view and use 2007 as a case study to determine the impact, from the perspective of the users or providers of funding. So that's the kind of data requirement there.
I would also add, if I could, some of the regulatory reporting requirements, in particular LRC, which you've talked about, are helpful because that information is going back quite a ways now over the last number of years. So that's becoming a more data that's already available and can be tracked fairly easily on the monthly or quarterly, depending on your filing system, but monthly typically system. So that's very, very good data, and it's obviously been scrubbed very well so that it's pretty accurate. So I'll just add that.
Yeah. Again, another important aspect, Paula, is to answer your question is really also looking at the different benchmarks. We have studies available which are going to help us calibrate the core versus volatile versus interest rate sensitive segments of deposits, and we can benchmark those studies.
Okay, great. The other one is, I think the gentleman left, but how often should this be undertaken?
Yeah, so as we said earlier, big banks, they undertake this exercise, quite frequently. I think this exercise should be triggered by any expected or anticipated changes in interest rates, and of course, both pre and post interest rate changes or yield curve changes in the marketplace. Any potential changes within the organization from an optimization perspective.
Okay, awesome. And last one is, what are the steps required for the implementation of transfer pricing?
Well, yeah, transfer pricing is a program-based approach. I think it's a fairly elaborate framework which requires a fuller understanding of the liability products, not just the liability products, but also the asset side of the equation or the balance sheet. And from that perspective, the key requirement here is developing an internal yield curve. We talked about understanding from a notional perspective what yield curve is the organization on. So in other words, if you were to actually reach out to the market, you want to be able to see that if the market is actually at what rate you are able to generate funds, and that's really your internal yield curve. Now, this could be really a point in time or interest rate at a point in time that you're being charged, or this could be really a formal yield curve, with various characteristics attributed to yield curve. Now, if you were to think of it that you're on a certain yield curve, with different time durations for different products, then you need to look at the bid-ask spread associated with that yield curve and use that as the baseline. So clearly, it's a very elaborate framework that requires a very sophisticated level of analysis, and then it has governance implications as well. It also has implications from the perspective of internal profitability, internal compensation associated with generating a certain segment based revenue versus payments made to the providers of liquidity and so forth. So it has governance implication, it has internal profitability type implications, but the end result is that it insulates you from liquidity risk, it insulates you from interest rate risk, and it creates an internal clearing mechanism from the perspective of deposit modeling and helps you mobilize and organize your projected growth rates, going forward.
Great. Thank you very, very much, Sohail. Any final comments? Andy, Sohail, any more questions from anyone?
I would just thank everybody for joining us tonight, and also just reinforce what Sohail's already said. The more you know about the behavior of your book, the better equipped you are to manage it better going forward. It's going to be, I think it's going to be a bit of a long haul with the situation that we're dealing with today, and so I think caution is really important, but being able to manage through this process, I think, will be very helpful. So thanks again to everyone. Thank you.
Okay, thank you, everyone. This is the final for our second webinar series and the number 2 episode. And we'll see you next time. Thank you.
Thanks, everyone. Bye-bye.
Bye.
Thank you. Bye-bye.